Hey Bowtie Nation, Joseph Hogue here, updating one of the most popular videos on the channel, the highest paying monthly dividend stocks, and I'm excited for this one. Our portfolio last year produced an average 10.7% dividend yield and a total return of 8%. Compare that to a loss of 10% on stocks in the S&P 500 over the period, and you can see why these are so popular. So not only did you get that high dividend yield and collect monthly cash flows, but the portfolio actually protected your money from the worst of the sell-off. I'll link to last year's monthly dividend stocks video in the description below, but for this list, I'm highlighting a totally new group, one with an average 10.8% dividend yield and one of the stocks as high as 16% yield. Now, I'll be ranking our monthly dividend stock list from lowest to highest paying, but stick around because I'm also going to show you how to analyze dividend stocks and reveal the risks you need to know. Before we get started though, I gotta send that special shout out to all my bowtie brothers and sisters, all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. First on our list of highest paying monthly stocks is actually the lowest yield of the group, Gladstone Capital, ticker GLAD, with a 7.3% dividend yield. Now even that though is still more than 4 times the dividend yield you're going to get on the overall market, and shares of Gladstone have added an additional 3% annual price return over the past 5 years. Now Gladstone is a business development corporation, a BDC, something we're going to talk about more later, and this chart shows an interesting idea for the group. Now this is the average portfolio yield for Gladstone since 2012, and notice rates were much higher before 2019. The average yield on its loans was over 11.6% in the 5 years through 2019 versus just 10.5% this year. So here, as those interest rates rise over the next couple of years, you're going to see the average portfolio yield rise as well. As long as the economy just doesn't fall apart and loan defaults don't jump, these BDCs are primed to book higher cash flow and pay out higher yields to their investors. In fact, we've already seen how BDCs do well even against the market crash this year. Shares of Gladstone are flat since January versus that drop of nearly 20% on the market and have continued to pay that dividend. But now remember, if you're overexposing a portfolio to just one type of company, especially these BDCs, you want to pay special attention to each company's sources of capital and its business. For example, for every BDC is going to show you the industries in which it loans and the types of loans it's making. You see here that Gladstone is well diversified across 17 industries, so a major event in any one group isn't going to materially affect the company. Next up is Prospect Capital, ticker PSEC, another BDC here with a 9.6% dividend yield, though not quite the price appreciation that we saw with Gladstone. Prospect was founded in 2004 and has over 16 years of dividends and performance. The company manages a $5.7 billion portfolio of 122 investments in companies across 39 industries and earns a 9.9% yield on its portfolio. That's more than enough to cover the stock's dividend yield, and this is another one that I like on that rising rate environment. Remember, BDCs make loans to small and mid-sized companies, those too big for the regional banks, but still too small to get money from the capital markets. And that portfolio yield that we talk about, that's the most important thing you want to watch for here. You're going to find this in any BDC's financial statements, called the weighted average portfolio yield, and it's the average interest rate the company makes on its loans. You want to make sure that that is above the dividend yield here. So a portfolio yield above that dividend is not only a sign the company can keep paying the dividend, but it's also making enough that you could see the stock price grow as well. Now, Prospect's portfolio yield is only slightly above its dividend yield right now, but it should head higher on those rising rates. This is something that I would watch with the stock though. The company has a strong history of cash return to investors, and in fact, Prospect has returned a cumulative $18.60 per share in dividends for more than $3.3 billion since its 2004 IPO, and that payout just keeps climbing. We've still got 5 more monthly dividend stocks to highlight, and I know picking stocks is the fun part of the video, but just as important is you need to understand the risks in these monthly dividend payers. You see, while most dividend stocks pay every 3 months, every quarter, there are actually hundreds of funds, ETFs, and these individual stocks that pay out monthly. But a lot of them are going to be the worst investment you can make. One problem is a lot of these highest paying monthly dividend stocks are going to be closed-end funds. These things, they draw investors in with those dividend yields of 12 and 15% and higher, but if you look at the share price, you're actually losing money. Look at these 2 monthly dividend payers, down 60% over the last few years, and it wasn't just that coronavirus crash. These stocks and a lot of those high yield funds, those closed end funds, see a constant loss of the stock price. And what most investors don't realize is while this is happening, that dividend is going to be cut as well. So you might start off with, say, a $20 share price and a $2.40 dividend, which is a nice 12% yield. But then if the shares fall 20% over the year to a $16 a share, and the dividend is cut to $1.92 each, which is still going to be that 12% yield. So it's still attracting those new investors, but you're kind of assed out now because not only are you sitting on a loss if you ever sell that stock, you're also collecting that lower dividend than you expected. I wouldn't just say don't invest in all closed-end funds outright, but most of them have this problem of destroying shareholder value. So with any high-yield dividend stock, just take a second to check out that price chart just to make sure it hasn't destroyed too much value. One more risk in high dividend investing, and we'll get back to our list. And here, watch out for the investing in just a few types of businesses. Now, picking the dividend stocks we'll talk about, I had to be careful because most of those monthly payers are going to be in just two business types, those real estate investment trusts or REITs, and the business development corporations or BDCs. REITs are just a special type of company that owns property or mortgages. BDCs, like we talked about, lend money to small and medium-sized businesses, as well as take an equity stake. So they're kind of like a bank and a private equity investor for small businesses. Now, both of these business types get a special tax break if they distribute the majority of their profits as dividends to investors. So you get investments with amazing yields, but there are some risks here that most investors don't understand. Both of these types of businesses are highly affected by interest rate changes. Now, real estate is highly leveraged with debt, so that interest expense is a big part of the business. The mortgage REITs borrow on short-term rates and then invest in long-term mortgages, so that's obviously directly tied to rates. And the BDCs are basically banks, so again, directly tied to interest rates. Now, the problem with this, other than just when rates do fall, it makes it harder for these types of businesses to make money, is that if you're out there looking for monthly dividend stocks and you just jump into a handful, then you're likely to end up with a portfolio that's really concentrated in just these BDCs and the REITs. For example, of the 68 monthly dividend stocks and funds I follow, nearly half, 29 of them, are in one of these two business models. So if half of your portfolio is in just two types of business models, then when those interest rate changes do come along, or some other change that affects these two industries, your portfolio is going to be in trouble, like you're eating ramen noodles the rest of your life kind of trouble. So now for this, within our list of monthly dividend stocks, I've added some that are a little lower yield, but are going to give you that diversification you need for that cash-safe portfolio. Back to our dividend list, and I wanted to add Cross Timbers Royalty, ticker CRT, for its 7.6% dividend yield and the diversification it brings. Cross Timbers is a royalty trust formed in 1991, which means it has royalty revenue rights to its properties in Texas, Oklahoma, and New Mexico, but doesn't have to do anything for it. The properties, which confusingly enough aren't timber woodland but oil and gas properties, are operated by XTO Energy, which pays all the costs and just passes on that royalty share onto Cross Timbers to disperse it to shareholders. And the company has a solid history of dividend returns and should continue to produce that return, especially with oil prices where they are now. Next on our dividend stocks list, Pennant Park Floating Rate Capital, ticker PFLT, yields a 10% dividend with an important upside. Now, Pennant is another BDC, but specializes in floating rate loans, something that could help it increase the yield as those interest rates rise. 87% of the portfolio is in secured debt on first liens, with another 13% in equity investment to give it even more upside growth. The company's current portfolio of loans to 115 companies is diversified across more than 30 industries, with an average loan size around $10 million. Now, we've still got that last monthly dividend stock with a 16% yield, and two more I'm adding to the portfolio, but I want to give you 3 points to watch for when analyzing these monthly dividend payers. And those of you in the nation know I'm not about just to drop a list of stock picks in your lap. I want you to know how to look for these stocks, what to watch, so you become a better investor. And here first, I'm looking for companies with a strong dividend yield, but not at the risk of cash flow problems. You'll see in a lot of high yield stocks out there, the company is keeping nothing back in cash flow, so that liquidity is a constant threat. Instead, I want companies that are able to keep up with that dividend, but also reinvesting in the business for growth. Now, analyzing a company's cash flow can be as simple as just a quick look at the cash flow statement in the financials. And this operating cash flow is the cash generated from the core business operations. So a great measure of how much cash the company can produce and that trend. You can also look at this free cash flow at the bottom, which is just the operating cash flow minus capital expenditures, or what the company needs to reinvest in the business. Now, a trend upwards in both of these is a great sign that the company can continue to pay and grow its dividend. I'm also generally going to be looking for larger companies, ones with a market cap over $3.5 billion, though I will break this rule on occasion if a stock meets the other two criteria. Basically here, I just want to make sure the company has that financial power and the size to survive a recession, no matter what. Companies that are going to have that access to credit if they need it. Now, you can find the market cap of a company on any statistics page or the main ticker page, and again, it's just the total market value of all the shares outstanding. Finally, I'm going to check out the dividend history of the stock. I can go here to Yahoo Finance under the historical data tab in the menu and change it to this show dividends to see that consistency and growth in the payouts. Of course, I'm also looking for companies with a yield of 6% or higher and that payout on a monthly basis. Now, the overall market averages around a 2% yield, so these stocks are paying more than 3 times the market average. We've still got our highest dividend yield stock to reveal, but I want to top our list off with 2 monthly dividend stocks that didn't quite make the cut for the highest yield, but I think add some great diversification and total returns to your portfolio. The first is one we've talked about on the channel before, Stag Industrial, ticker STAG, with its 4.5% dividend yield. Now, that 4.5% yield may seem like a letdown after others with a 10% dividend, but Stag has also produced a 4.8% annual return on top of the dividend over the last 5 years, and it's one of my favorite property types right now. Stag owns 450 industrial and warehouse properties across 38 states for a total 91 million square feet. And while a lot of the other property types like office and retail struggled during the pandemic, the warehouse market was red hot. The rise of e-commerce and online shopping has destroyed the retail property market, but all those online orders need to be stored somewhere, and that's meant a boom in warehouse demand. In fact, 43% of Stag's property portfolio is in that e-commerce activity. So with Stag, you're not only getting that dividend yield that's still almost 3 times the market average, but exposure to a part of the real estate market that should drive returns for decades. Now, if you thought adding Stag to a list of high-yield stocks was questionable, then you're going to think I've gone totally batshit crazy adding Gladstone Land, ticker LAND, with its paltry 2.3% yield. But there are a lot of reasons to add land to your portfolio besides just that dividend yield. The shares have produced a 16% annualized price return over the past 5 years, actually making it one of the highest total returns on the list. Now, also, the stock is down 32% from its recent peak, so the potential here for some real value. Land is a farmland real estate trust with 164 farms and 113,000 total acres across 15 states. Acreage is 100% leased, and besides industrial, this is another one of my favorite property types. Farmable land per capita has halved over the last 60 years, even as global food demand surges. Farmland values continue to rise, and this is an uncorrelated asset with stocks. That means it's going to do a great job of smoothing out that roller coaster ride in stock prices when the market crashes. And here, our highest dividend yield on the list, Armour Residential REIT, ticker ARR, pays a 16% yield, but this is one you might want to watch before buying. That's because that 16% yield might be tempting, but the environment for mortgage REITs is tough right now, so the weakness in the share price might not be over. The company borrows on those short-term rates to invest in those longer-term mortgages and has a portfolio of $8.1 billion in residential loans and U.S. Treasuries. Now, the problem here is against those higher interest rates that should mean stronger returns, mortgage demand has dropped, so all the mortgage REITs are down hard this year. Still, though, it's a dividend yield that you don't want to miss, so I'd watch this one and consider picking up shares later on this year if the economy approves. Click on the video to the right for my 3 favorite monthly dividend ETFs, 3 monthly dividend funds that will pay your bills. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.